In this video, we're going to talk a little bit more about behavioral finance. We've talked about market efficiency and how information gets into prices and how theoretically you would expect this to be a rather structured event that you could be able to find assets and invest in them using information. You might not be able to get abnormal kinds of returns, but you can still make some money. But this kind of flies in the face of what we actually see in real life. We see that markets don't seem to react the way we would expect them to, given the efficient market hypothesis. So the reason for this is posed or is presented as what's now referred to as behavioral finance. So there's lots of evidence of market efficiency, but still there are these anomalies. These things happen that we can't explain. So in this video, we're going to talk a little bit about what investors do and how they're creating this, or a potential explanation for what we see with respect to prices and how they move. So the first evidence, if you will, or theory or hypothesis is something referred to as overconfidence. Investors tend to be overconfident in their abilities, and this leads them to underestimate risk. So if they're underestimating risk, that means they're going to be buying things more frequently than they should, which again can lead to some biases. Self-attribution bias. Again, investors tend to take credit for successes, but they blame other people for the things that are out of their control or their failures. So what this does is these things tend to cause investors to trade too much. And since they're trading a lot, they're going to have higher transaction costs and therefore also lower returns. Loss aversion is the tendency to exhibit risk-averse behavior when you're looking at gains, but then risk-seeking behavior when you're confronting losses. In other words, investors might hold off to investments that have lost money longer than they should have. That is, when you think about, well, people don't want to, they keep waiting possibly for a stock to turn around. It's lost some money, surely it will turn around. So again, there's some studies have shown a tendency for stocks that investors sell to perform better than the stocks that they choose to hold. That is, they hold things too long. Representativeness is a cognitive bias that occurs because people have difficulty thinking about the random nature of prices. So one of the concepts here, something called overreaction. Investors overreaction to good performance, and they overestimate the likelihood that it's going to continue. So when things are happening well, we overestimate that it's going to continue. That is, we see things going bad and we don't anticipate when it's going to turn around. So this could happen if a company wants to make an acquisition of a company that's been growing faster than its competitors. For some reason it's going very fast. And we pay a premium for this, even though that event or that particular thing that was causing the growth has disappeared. We're slow to react. We're slow to take that into account when we're purchasing assets. Now, underreaction basically says investors may underreact to new information. So again, what this could do is, like, when we see good information, we recognize it, but we don't recognize with the same fervor as what we might otherwise. So this means that there is a price change, as in the when we talk about the price earnings announcement drift, we see that there is a change in price, but because we didn't address fully that price, since we didn't act strong enough, what we ultimately find out happening is that the price continues to grow for continued growth moving forward. Narrow framing basically says we tend to analyze a situation in isolation. That is, we just look at a small window. We don't look at the big picture. And this can happen when we're thinking about retirement planning and the risk, etc., that is associated with making allocation changes with retirement. Another concept that can help us maybe understand why prices don't act the way they should is that investors tend to ignore information that conflicts with their existing belief. They think something is true, and when they see evidence that is contrary to that, they just don't believe it. They don't react to it. So what this can do, right, is they might even avoid gathering new information. They might not even go out and search more because maybe it might contradict, right, their initial options and their initial opinion, of the stock's potential. Anchoring. And again, if you kind of think about these things, all of these things individually, they create actions by investors that are contrary to what the efficient market hypothesis, to what the theory of investing says should be true. So if the theory says it should happen X, but we act a certain way, it counter affects the reality, if you will, the theoretical reality of what should happen to prices. So in anchoring, right, we're going to attempt to predict an estimate for some unknown quantity, but we're going to place too much weight on that information, even when maybe we don't even know that much about that information, or maybe if the information isn't even particularly relevant to the stock. So we're going to estimate some market returns anchored on the market's recent past returns. Well, maybe those two things aren't really connected to each other. Familiarity bias basically says we tend to buy stocks that are familiar to us without regard to whether or not they're good buys or not, right? So this might lead us to hold under-diversified portfolios, holding a portfolio that is too small relative to the information, relative to the theory of spreading out our investments over a variety of investments. So the contribution of behavioral finance really is to try to identify those psychological factors that lead investors to make systematic mistakes. And then, obviously, determine whether those mistakes contribute to patterns that we see in stock prices. If this is the case, the mistakes of some investors may be the profit opportunities to others. In other words, if we can identify these mistakes that people make, and then we can turn that into a prediction of what should happen given that mistake, we now have opportunities for profits that might not be available or wouldn't be available in a truly more systematic, theoretically moving environment. So what does this tell us about investments? Well, we basically have 5 steps here, right? Don't hesitate to sell a losing stock, right? If you do sell it and you sell it too soon, you can always buy it back. Don't chase performance, right? Almost every investment flyer, investment information packet that you see will tell you that the past does not guarantee future performance. So don't get hung up on what it's done in the past. Be humble, be open-minded. Recognize that sometimes your past decisions, Sometimes the information that you receive is correct, regardless of what you think you know about the event. We need to review our performance on a very periodic basis, right? Waiting a year or 2 years before you readjust or make adjustments to a portfolio just might be too long. And in the end, don't trade too much. Just because you see a potential change does not mean that it's time for you to make a trade, right? So considerable evidence indicates that if you trade a lot, you typically don't perform very well. So I'll talk to you in the next video.